The dream of every trader, from the seasoned veteran to the aspiring day trader, is to anticipate market reversals, those pivotal moments when the market's direction shifts, offering immense opportunity or signaling impending danger. Jesse Livermore, one of the greatest speculators in history, didn't rely on luck or intuition. His prowess stemmed from a profound analytical understanding of market behavior, a method rooted in meticulous observation and data-driven insights. This isn't about gazing into a crystal ball. It's about mastering a systematic approach. In this comprehensive 10-step guide, we distill the timeless principles that allowed market titans like Livermore to navigate and profit from the market's turning points, providing you with a practical framework to enhance your own predictive capabilities. 1. Assess the overall market trend and cycles. Before even considering individual stocks or commodities, a successful trader must first grasp the overarching market trend and its current cycle. This foundational step is paramount, for attempting to predict reversals without this broader context is akin to navigating a ship without knowing the direction of the ocean's currents. The market operates in cycles, periods of expansion, contraction, and consolidation. Identifying whether the market is currently in a primary bull, bear, or sideways trend provides the essential backdrop against which all other analyses must be weighed. During a bull market, upward movements are generally sustained, and corrections are typically shallow and short-lived, with strong buying interest quickly emerging. Conversely, a bear market is characterized by persistent downward pressure, where rallies are often fleeting and met with heavy selling. A sideways or consolidating market, on the other hand, lacks a clear directional bias, with prices oscillating within a defined range. The key here is to focus on the broad macro movements rather than getting bogged down in the minutiae of daily fluctuations. Tools such as long-term moving averages, trend lines on weekly or monthly charts, and macroeconomic indicators can help in this assessment. For instance, consistently higher highs and higher lows on a broad market index like the S&P 500, accompanied by increasing volume on upswings, would signal a healthy bull market. A break below key support levels and the formation of lower highs and lower lows, especially with expanding volume on down days, would indicate a shift towards a bear market. Understanding these larger forces allows a trader to align their strategy with the path of least resistance, making it easier to identify potential turning points when they occur against the prevailing tide. This initial assessment acts as a filter, informing whether a potential reversal in an individual asset is a significant shift or merely a minor counter-trend move within a larger established direction. Without this macro perspective, individual signals can be misinterpreted, leading to costly errors. It's about seeing the forest before examining the trees, ensuring your tactical decisions are strategically sound. 2. Determine the line of least resistance. Double asterisk. The concept of the line of least resistance is a cornerstone of understanding market dynamics, asserting that prices, like water, will always follow the path of least opposition. For a trader, this means identifying whether it is easier for a stock or commodity to move up, down, or remain within a trading range. This isn't about forecasting. It's about observing the current momentum and underlying forces. If a stock consistently makes higher highs and higher lows, and pulls back on low volume, its line of least resistance is clearly upward. Conversely, if it consistently fails to break above resistance, making lower highs and lower lows, its path is likely downward. A sideways market indicates equilibrium, where neither buyers nor sellers have a dominant edge, and the line of least resistance is horizontal. To determine this, one must analyze price action in conjunction with volume over a relevant time frame. For example, if a stock attempts to break out of a consolidation range to the upside but is met with heavy selling volume at the resistance level, it suggests that the path of least resistance is not yet upward, or perhaps even downward if selling pressure intensifies. Conversely, a strong breakout on high volume indicates that the path has cleared for further upward movement. Trading in the direction of the line of least resistance significantly increases the probability of success. as you are moving with the market's natural flow rather than against it. Fighting the market's prevailing bias is a common pitfall for inexperienced traders. Livermore famously stated that he never argued with the tape. He simply followed where it led. This principle encourages patience and discipline, waiting for the market to clearly reveal its easiest path before committing capital. It's about recognizing the inherent inertia of the market and capitalizing on it, rather than trying to force a direction that isn't supported by the underlying supply and demand dynamics. By consistently asking, what is the easiest direction for this asset to move right now? Comma traders can refine their entry and exit strategies, ensuring they are always aligned with the market's most probable trajectory. 3. Master price action analysis. Price action is the raw, unadulterated truth of the market. It represents the collective decisions of all participants, buyers and sellers, and is often the most reliable indicator of future movements. Mastering price action analysis means meticulously observing the movements of prices on a chart, without the distraction of complex indicators, to identify patterns, trends, and key levels. This involves studying candlesticks or bars, their shapes, sizes, and sequences, to discern the underlying sentiment. For instance, a series of large bullish candles closing near their highs, especially after a period of consolidation, signals strong buying pressure. Conversely, long bearish candles closing near their lows indicate aggressive selling. The formation of specific candlestick patterns, such as engulfing patterns, hammers, or shooting stars, at critical junctures can provide powerful clues about potential reversals. Identifying support and resistance levels is fundamental to price action. Support is a price level where buying interest is strong enough to prevent the price from falling further, while resistance is a level where selling pressure is strong enough to halt an advance. When these levels are repeatedly tested and held, they become significant. A break of a major support or resistance level, especially on high volume, is a crucial signal that the balance of power has shifted and a new trend or reversal may be underway. Furthermore, observing trend lines and channels helps to define the current trend and identify potential points where the trend might accelerate or reverse. A break of a significant trend line, particularly if confirmed by other factors, often precedes a change in direction. Price action teaches you to read the story the market is telling moment by moment without relying on lagging indicators. It's about understanding the psychology embedded in every tick and every bar, recognizing when buyers are exhausted or sellers are capitulating, and positioning yourself accordingly. This direct engagement with the market's raw data fosters a deeper, more intuitive understanding of its ebb and flow, making you more attuned to the subtle shifts that precede major reversals. 4. The critical role of volume analysis. While price action tells you what the market is doing, volume tells you how forcefully it's doing it. Volume is the fuel that drives price movements, and its critical role in confirming the strength of trends and potential reversals cannot be overstated. High volume accompanying a price move signifies strong conviction and broad participation, validating the move's sustainability. Conversely, low volume suggests a lack of conviction, indicating that a price move may be weak or temporary. For instance, a strong upward price movement on high volume indicates accumulation. Smart money is buying, and the trend is likely to continue. If the price rises on low volume, it suggests a lack of genuine buying interest, and the rally might be short-lived, potentially indicating distribution or a weak bounce. When looking for reversals, volume provides crucial confirmation. A sharp reversal candle accompanied by significantly higher than average volume is a powerful signal that the balance of supply and demand has shifted dramatically. For example, if a stock has been trending upward and suddenly experiences a sharp decline on exceptionally high volume, it signals that large players are aggressively selling, indicating a potential top and reversal. Similarly, a stock finding support and bouncing sharply on high volume after a prolonged downtrend suggests strong buying interest re-entering the market, signaling a potential bottom. Volume also helps in identifying false breakouts or breakdowns. A price breaking above a resistance level on low volume is often a trap, as the lack of conviction means it's likely to fail and revert. A true breakout, however, is typically accompanied by a surge in volume, confirming genuine buying pressure. Analyzing volume patterns over time, such as increasing volume on upswings and decreasing volume on downswings during an uptrend, and vice versa for downtrends, provides insight into the health of the trend. Divergences between price and volume, for example, prices making new highs but on decreasing volume, can be a strong warning sign of an impending reversal, indicating that the underlying buying pressure is waning. Incorporating volume analysis into your framework adds another layer of confirmation, allowing you to differentiate between significant shifts and mere market noise, thereby improving the reliability of your reversal predictions. Navigating the complexities of market analysis, understanding the interplay of price and volume, and deciphering historical patterns can be a daunting task. For those looking to deepen their understanding of market dynamics and the strategies employed by legendary traders, or for those fascinated by the rich history of finance, there are invaluable resources available. Our channel, Trading Insights, delves deep into the strategies, methods, and core principles of specific traders, speculators, and investors, offering a practical lens through which to view market mastery. Concurrently, for a broader historical perspective, the Wall Street Memoirs channel explores the epic sagas of financial crises, pivotal historical events, and the remarkable figures who shaped Wall Street's narrative. Imagine gaining insights into how past titans navigated their markets, or understanding the historical context that underpins today's financial landscape. These channels offer a treasure trove of knowledge, bridging the gap between historical wisdom and modern application. To truly elevate your trading acumen and historical understanding, we encourage you to explore both. You'll find links to both the Trading Insights channel and the Wall Street Memoirs channel in the description below. Subscribe to uncover the secrets of market success and the captivating history that defines it. 5. Identify pivotal points. Double asterisk. Pivotal points are more than just support and resistance levels. They are critical price junctures where the market's direction is likely to be decided, often initiating significant movements. Jesse Livermore placed immense importance on these points, recognizing them as optimal moments for entering or exiting a position with the greatest potential for profit and minimal risk. A pivotal point is typically a price level where a stock has either consolidated for an extended period before breaking out, or a level where a previous significant high or low was made. When a stock approaches such a point, it signals a moment of truth. If it breaks above a pivotal resistance point with strong volume, it suggests a new upward trend is beginning, and the previous resistance now acts as support. Conversely, a break below a pivotal support point indicates a new downward trend. The key characteristic of a pivotal point is its ability to trigger a substantial move once breached. These are not minor fluctuations, but significant thresholds that, once crossed, tend to lead to sustained directional momentum. Identifying these points requires a keen eye for chart patterns and an understanding of market psychology. For example, a stock that has been in a long downtrend might form a base, oscillating within a tight range. The upper boundary of this range, if broken with conviction, becomes a pivotal point, signaling a potential reversal to an uptrend. Similarly, a stock in a strong uptrend might consolidate, and a break below the lower boundary of that consolidation could be a pivotal point indicating a top and subsequent reversal. Livermore emphasized waiting for the market to confirm the breakout or breakdown from these pivotal points before acting. He would not anticipate. He would react to the confirmation. This means entering a trade only after the price has clearly moved beyond the pivotal level and sustained its position, ideally accompanied by confirming volume. This disciplined approach minimizes false signals and ensures that your trades are aligned with confirmed shifts in market direction. By focusing on these high-probability turning points, traders can concentrate their efforts on the most impactful opportunities, significantly improving their strike rate and overall profitability. 6. Distinguish between normal and abnormal reactions. Understanding the difference between a normal market reaction and an abnormal one is crucial for discerning the health of a trend and anticipating potential reversals. A normal reaction within a healthy trend is a temporary, relatively small pullback or correction that occurs on decreasing volume, after which the primary trend quickly resumes. For example, in a bull market, a stock might advance strongly for several days, then pull back 3 to 5% on lighter volume as some profit takers exit. If this pullback is orderly and the stock then resumes its ascent on renewed volume, it's a normal, healthy consolidation. This indicates that the underlying buying pressure remains intact, and the market is simply digesting its gains. An abnormal reaction, however, is a significant warning sign that the trend may be weakening or on the verge of reversing. This is characterized by a sharp, often substantial price decline on unusually high volume, or a failure of the price to recover quickly after a pullback. For instance, if a stock in an uptrend suddenly drops 8 to 10% or more in a single day, especially if accompanied by a surge in selling volume, this is an abnormal reaction. It suggests that institutional money is aggressively distributing shares, indicating a potential top. Similarly, if a stock experiences a pullback but then languishes sideways for an extended period without resuming its upward trend, despite favorable market conditions, this can also be an abnormal signal of underlying weakness or distribution. Increased volatility, especially during price declines or churning action where prices move sharply but make little directional progress on high volume, are also indicators of abnormality. These signals suggest that the market is undergoing a fundamental shift in supply and demand. Traders must be vigilant in observing these reactions. A normal reaction is an opportunity to add to a winning position or initiate a new one with confidence. An abnormal reaction, however, demands caution, potentially signaling the need to reduce exposure, tighten stop losses, or even reverse one's position. Learning to differentiate these reactions through careful observation of price and volume patterns is a hallmark of experienced traders, allowing them to exit dangerous situations and capitalize on confirmed trend changes. 7. Observe market leaders. Market leaders are the bellwethers of the broader market, often exhibiting signs of strength or weakness long before the general market or other stocks in their sector. Paying close attention to these leading stocks in leading sectors is a powerful method for anticipating overall market reversals. In a healthy bull market, you'll typically see a rotation of strong leaders, with new stocks emerging to take the helm as others consolidate. These leaders are characterized by robust price action, strong fundamentals, and significant institutional interest. They are the first to make new highs and often show resilience during minor market corrections. However, when these market leaders begin to falter, it's a critical warning sign that the broader market may be heading for trouble. If the leading stocks in the leading sectors start to show abnormal reactions, for example, failing to make new highs, experiencing sharp declines on high volume, or breaking below key support levels, it suggests that the smart money is beginning to exit, signaling a phase of distribution. This often precedes a general market downturn. Livermore understood that the big money moved out of the best stocks first. A market cannot sustain an uptrend if its strongest components are weakening. Conversely, in a bear market, the first signs of a potential bottom often emerge when leading stocks stop making new lows and begin to show relative strength, forming bases or even starting to trend upward while the rest of the market is still declining. This early strength in leaders can be a precursor to a broader market recovery. Therefore, a diligent trader maintains a watch list of current and emerging market leaders. Regular analysis of their price and volume action, comparing their performance to the broader market and their sector, can provide invaluable early warnings. A shift in the character of these leaders, from aggressive advance to hesitant consolidation or outright decline, is a powerful indicator that the market's underlying health is deteriorating and a reversal may be imminent. This proactive observation allows traders to position themselves ahead of the curve, either by reducing exposure during a topping phase or by identifying early opportunities during a bottoming process. 8. The element of time for confirmation. Time is a critical, yet often overlooked factor in confirming the validity of a trend and its potential reversals. A healthy trend, whether up or down, exhibits a certain rhythm and predictability in its duration and reaction to events. When this rhythm is disrupted, it serves as a powerful warning sign. For instance, in an uptrend, after a normal reaction pullback, the stock should typically resume its upward movement relatively quickly. If a stock experiences a pullback and then enters a prolonged period of sideways consolidation without making new highs, especially if this consolidation occurs on increasing volume or shows signs of distribution, it suggests that the upward momentum is waning. The longer a stock lingers sideways after a correction without resuming its trend, the higher the probability that the trend is exhausted and a reversal is brewing. Livermore often spoke about the importance of time in the market and waiting for the market to confirm his analysis over a sufficient period. He wouldn't rush into a trade based on an immediate signal. He'd observe how the market behaved over days or weeks after a potential pivotal point or abnormal reaction. This patience allowed him to filter out false signals and confirm the true underlying sentiment. Similarly, a breakout or breakdown from a pivotal point needs time to confirm its validity. A quick snapback after a breakout can indicate a false move. True breakouts often involve a retest of the breakout level, which then holds as support or resistance, confirming the new direction. The duration of moves and reactions provides valuable data. Recording and analyzing how long it takes for a stock to recover from a pullback or how long it stays in a consolidation phase can reveal patterns of trend exhaustion. If typical corrections in an uptrend used to last a few days but now extend for weeks, it's a sign that buying pressure is weakening and sellers are gaining control. This temporal analysis adds a crucial dimension to price and volume observation, helping to distinguish between temporary pauses and fundamental shifts in market dynamics. It teaches traders to respect the market's natural pace and to wait for clear, time-confirmed signals before committing capital, thereby enhancing the accuracy of reversal predictions. 9. Implement strict risk management. While predicting market reversals is about identifying opportunities, the foundation of long-term trading success lies in rigorous risk management. Preservation of capital must always be the trader's paramount priority. This means never risking more than a small percentage of your capital on any single trade and, most importantly, cutting losses swiftly and without hesitation. Jesse Livermore famously stated that the big money is not made in buying or selling but in waiting. And when a trade goes against you, the best action is often to exit quickly. The concept of stop loss is not merely a suggestion, it is an absolute necessity. Before entering any trade, a clear, predetermined stop-loss level must be established. If the price moves against your position and hits this level, the trade is closed, regardless of your hopes or beliefs. This prevents small, manageable losses from escalating into catastrophic ones. A cardinal rule is never to average down on a losing position. Adding to a losing trade, hoping for a turnaround, is one of the quickest ways to deplete trading capital. If your initial analysis was incorrect, doubling down on that mistake only compounds the risk. Instead, if a position is losing, it indicates your initial thesis was flawed and it's time to reevaluate or cut ties. Conversely, when a trade is working in your favor and the trend is strong, Livermore advocated for pyramiding, gradually increasing your position as the price moves in your anticipated direction. This is done by adding shares at higher prices, in an uptrend, or lower prices, in a downtrend, but always on strength and only after the market has confirmed your initial bias. This method allows you to build a substantial position in a winning trade while maintaining risk control, as each subsequent addition is made from a position of strength. Never initiate an aggressive, large position at the outset. Instead, build it up incrementally as the market validates your decision. Strict risk management is not just about placing stop losses. It's a mindset that prioritizes survival over maximizing every single trade. It's the discipline to protect your capital at all costs, ensuring you remain in the game to capitalize on future opportunities, especially when correctly anticipating major market reversals. For those eager to delve deeper into the mind of Jesse Livermore and extract practical lessons from his unparalleled career, a new edition of Reminiscences of a Stock Operator offers an indispensable resource. This isn't merely a reprint of a classic. It's an enhanced journey into the psychology and strategies that defined Livermore's success and failures. Each chapter is now complemented by expert commentary and analysis, translating his historical experiences into actionable insights for the modern trader. Imagine understanding the nuances of his decision-making process, not just as a narrative, but as a blueprint for developing your own market intuition and discipline. This edition provides a unique opportunity to learn directly from the master's triumphs and mistakes, offering practical lessons on everything from risk management to anticipating market turns. It's about taking Livermore's profound observations and turning them into practical tools for your own trading arsenal. If you're serious about mastering the art of speculation and truly understanding the psychological underpinnings of market movements, this book is an essential read. Don't just read about history. Learn from it in a way that directly impacts your future trading success. Find the link to this new, insightful edition in the description below and unlock the timeless wisdom of Jesse Livermore. 10. Master the psychology of trading and patience. Ultimately, the success of any trading strategy, no matter how robust, hinges on the trader's ability to master their own psychology and cultivate unwavering patience. The market is a relentless testing ground for human emotions, and the greatest enemy of a trader is often not the market itself, but their own hope, fear, and greed. Emotional control and discipline are not abstract concepts. They are tangible skills that must be honed and maintained. Hope, for instance, can lead traders to hold on to losing positions, hoping for a miraculous turnaround, turning small losses into massive ones. Fear can cause traders to exit winning positions prematurely, missing out on significant gains, or to hesitate when a clear signal presents itself. Greed can push traders to over-leverage, chase fleeting opportunities, or violate their risk management rules. Livermore famously said, "The money is made by sitting, not by trading." This emphasizes the profound importance of patience, waiting for the clearest signals, waiting for the market to confirm your analysis, and then patiently holding positions that are moving in your favor. It means resisting the urge to constantly be in the market, and instead waiting for high-probability setups that align with your strategy. Understanding market psychology involves recognizing that extreme levels of fear, panic selling, often mark market bottoms, while extreme levels of greed, irrational exuberance, frequently signal market tops. These emotional climaxes can be powerful indicators of potential reversals, but only for those who can remain detached and objective. Cultivating this detachment requires a deep understanding of oneself, the ability to stick to a predefined trading plan, and the discipline to execute that plan without emotional interference. This includes accepting losses as an inevitable part of trading, not as personal failures. It means learning from mistakes without letting them paralyze you. Developing this mental fortitude allows traders to act rationally when others are acting emotionally, which is precisely when the greatest opportunities for predicting and profiting from market reversals arise. Patience combined with disciplined emotional control transforms raw market data into profitable decisions, making it the ultimate differentiator between consistent success and fleeting gains. In conclusion, the ability to anticipate market reversals like Jesse Livermore is not a mystical gift, but a cultivated skill, built upon a foundation of analytical rigor, meticulous observation, and unwavering discipline. By systematically applying these 10 principles, from understanding the broad market trend and identifying the line of least resistance, to mastering price action and volume, pinpointing pivotal points, discerning normal from abnormal reactions, observing market leaders, appreciating the element of time, implementing strict risk management, and finally, mastering trading psychology and patience, you can significantly enhance your capacity to navigate the market's turning points. Success in trading is a continuous journey of learning, adapting, and refining your approach. Embrace these timeless principles, commit to consistent practice, and cultivate the mental fortitude required to act decisively when opportunities arise. The market is always presenting new challenges and new lessons, and by staying disciplined and analytical, you too can learn to read its subtle cues and position yourself for profitable outcomes. For those with an insatiable curiosity for the rich tapestry of financial history and the dramatic narratives that shaped Wall Street, we highly recommend 50 Years in Wall Street. These illustrated memoirs by Henry Clews, presented in 2 compelling volumes, offer an unparalleled journey through half a century of Wall Street's evolution, from the tumultuous panic of 1857 through the Gilded Age of rapid industrial expansion and intricate market manipulations. It's a vivid chronicle featuring the titans of finance, the epic battles for control, and the daring strategies that defined an era. Beyond the enthralling stories of prominent financiers, Clews provides a unique insider's perspective on the very mechanisms of the market, the ethical quandaries, and the speculative frenzies that have always characterized financial markets. This work is not just history. It's a masterclass in understanding the enduring human elements that drive market behavior, offering context and depth to the principles we've discussed today. To truly appreciate the historical context of market dynamics and the origins of many trading principles, 50 Years in Wall Street is an essential addition to your library. Delve into the fascinating past that continues to influence the present. You can find more information and acquire these remarkable volumes through the link provided in the description below.